One of the most common retirement vehicles that people utilize is this thing called the 401k. Now it's obvious that people utilize it because it's an employer-sponsored plan, meaning that when you work for a company and you get a W-2 income, the employer often will offer this retirement vehicle to you. And one of the attractive elements of this account is that you get a quote-unquote tax deduction. And so a lot of people have been kind of misled in a way that you get a tax deduction by putting your money into a 401k. In this video, what I'm gonna do is I'm gonna go through explaining exactly why that's not necessarily as clean and as you think it is, why it's not necessarily the case. I'm gonna explain exactly what it means for you from a tax implication perspective, where the value is, where the benefits are, and where potentially the risk is at having your money in a 401k. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and for this video, we're gonna be talking about 401ks, the tax ramifications. Do you really get a tax deduction with your 401k, or is it really something else that's going on? And I don't wanna be evasive around this. What I wanna do is jump right into this, and before I get into the details, I think what's important to do is take a look at the history of taxes. So what I'm gonna do is I'm gonna pop over to this screen here, and what I wanna do is I wanna talk about the history of taxes. And what you can see here is that we are in this all-time low tax rate environment. You can see the average tax rate is 56.94%, but you can see that, since let's say it was 1981 when the taxes were 69.13% over $215,000. Now, a lot of times that's the top bracket, and people are like, well, that doesn't really impact me, and that's okay. So let's talk about what this looks like. The federal income tax thresholds from 1913 to 2022. You could see with the institution of the Federal Reserve, and they implemented these new taxations, that most people let it in. It's kind of like the camel getting his nose in the tent, right? Like you get 1% tax rates and on income taxes, and people are like, all right, I'll pay 1% up to $20,000. Now remember, $20,000 back in 1913 was a lot of money. It was a lot of money. The top rate of 7% of 500,000 of income, 500,000 back then, I don't know a number, but my guess is that's something like $15 million a year. It's a big number, whatever it is. And you could see slowly those taxes went up, they came back down. The Great Depression happened, taxes came down on the kind of lower income brackets. You could see the tax threshold was low, and taxes went up. You could see really fast on the tax bracket for the wealthy people. So you could see that, these numbers on the upper income brackets, they fluctuated greatly, and they have fluctuated greatly, not just on the percentage that they pay, but on what the tax thresholds are, what the highest tax brackets were. So everybody thinks today that it's like unique to think that we need to go after and tax the ultra wealthy. Well, this is exactly what they did back then. And what we've already done, and what we've already discovered, is that taxing the ultra wealthy just doesn't work, because it disincentivizes the most productive people in the world to keep producing. And so that winds up having a negative impact, on our economy, on our overall productivity as a country, as a nation. That has an impact on jobs and all these different things. And so you can see we've gone up, we've gone down. Obviously, different political regimes come into play. It has an impact on the brackets. Now you can see when World War II happened, the initial rate for the lower income brackets had a huge jump, right, during World War II, because you could see back then for the income bracket went down from 4,000 to 2,000, which basically cut that in half, but the jump in the rate actually jumped as well. So the taxes were a massive burden. Now they had to do this because they had to pay for war. And this is something back then that they understood. We had to get through that war. It was obviously a world war. It was a world crisis, and you could see the income on the wealthy people was really, really impactful. Now, why am I showing you all this? It's just understanding when we look at this and understand the tax thresholds, the tax brackets. And I want to show this is like, we are in this low all-time rate of taxes. When I go back here in the 80s, we have 50% and greater on the top end. We have 11% down here. And then you can see here on the bottom end, we have 10% for the lower end of the tax bracket. We're only at 37%. And when we kind of zoom out on this and we take a look at it visually here on this is the top end brackets, you can see just from this bar graph that like rates are at all-time lows, right? From a historical perspective, when you take out of consideration the first couple years that they instituted this as a way to, that they instituted federal tax brackets as a way to just kind of get their nose in the tent and to try to, kind of dupe us into this income tax bracket situation where they're basically taking money from the populace, right? Like that's what they're doing, and it's obviously become law. There's a lot of people that would argue that it's unconstitutional the way they do the federal tax bracket, but I would also argue if you don't pay your taxes, you're pretty much going to jail. So you better play ball. Ultimately, is what it comes down to. And so when I look at these numbers, when I look at what the tax brackets are, and I say, all right, well, we know that taxes are lower. We know that our debt, our national debt, is at an all-time high, because when we look at the debt back then, when we look at the wars that we were fighting, remember the 80s, we had the Cold War finishing up. We had Desert Storm in the 90s. We've had, the Afghanistan thing after the Twin Towers were hit. We've had all these things happen, but taxes have stayed low during this time when we had to fund these wars. That played a big part. The military industrial complex had a big part in pushing up our debt. Now, am I saying that's all there is? No, there's obviously all these unfunded liabilities and a lot of other things going on, right? So what I want to do here is I want to show this for 1 second. You can see we're $31 trillion in debt right now, and you can see the rate at which our debt is going up. But the most staggering numbers right here are the unfunded liabilities. The US unfunded liabilities right now are $187 trillion, right? Right here. And you can see that the liability per citizen is $559,000. That is just insanity to me. Like that is not a sustainable number. And this is a bubble, and it's a debt bubble that has to pop. And the question is, what's that gonna look like? And what is the ramification of that? And how do we deal with this? So at the end of the day, when you look at the combination of debt and you look at the combination of our lowest tax rate environment that we've ever been in, and then you look at the history of the tax rates and you realize that they have to go up, then common sense goes, okay, well, tax rates have to go up. So now that gets me back to the 401k, and it gets me thinking, all right, what does that look like? Well, here's what I want to do. I want to go through this, and I want to run through this on my board a little bit and just kind of talk about something here. So when you put your money into a 401k, that money goes into a 401k, and people think you get a deduction. And a deduction is a pure thing saying like, all right, if I earn $100,000 and I save 10%, which is $10,000, that means I have $90,000. And the idea is this $10,000 is going in to your 401k, and now it reduces my taxable income, so I get a deduction on this $10,000, and I only pay earned income tax on this $90,000. That is true. You do get a deduction for that specific year. But the bottom line is this $10,000 here isn't really deduction. You're really getting a deferral. This $10,000, you defer paying taxes. So like right now, if you're in a 10% tax bracket, you're deferring paying 10% on that $10,000. And what it's going to do is it's going to go into your 401k, and that $10,000 is going to grow. And when you pull money out, and let's say you do it every year, you put $10,000 in for 20 years, and let's say at the end you have $350,000 or $400,000, whatever, it doesn't matter, at the end of 20 years. So at the end of 20 years, you have this $350,000, and you want to start taking income out. And 20 years from now, because of our debt and stuff, let's say taxes for you went up to 20%, which I don't think are unrealistic, even for the lower brackets. If they go up to 20%, all of a sudden, you deferring taxes will wind up costing you money on your tax liability throughout your life. Whereas you could have paid 10% on the money right out of the gate and paid like $1,000 a year and had control of that money and had it grow on a tax-free basis, you're now gonna have to pay 20% tax on any of this money that you take out as earned income. Because remember, you are reducing your earned income by $10,000 right here, right? But as it grows into this $350,000, when you pull that money out, you still have to claim it as earned income. So I think that's a really, really important dynamic to understand on the flow of money, on how all this stuff works. So think about it like this. Right now, if you are in a 20% tax bracket, right? Like let's say you have $1 million right now, and you got to the place where you had to compare two things, and you had the opportunity to have $1 million in a 20% tax bracket. Well, that means out of that $1 million you saved, your actual money that you have to pay on taxes is going to be $200,000. So effectively, $800K is actually your money. You could have $1 million in your 401k, but that's not really your money. This 20% taxes that you deferred, well, maybe you even deferred at a lower rate. So I always tell people you got to align your money with your values and beliefs. So if you believe taxes are not going to go up, well, then 401ks can be great for you. But if you believe taxes are going up, well, then putting your money in a 401k or IRA or any tax deferred vehicle, remember, you don't get a tax deduction, you get a tax deferral, is a big deal. So now if you have the same $1 million, check it out, and you have 30%, now you have $300,000 is what your liability is for taxes. So now you have $700K left, that's yours. You basically lost $100K. Now this is one of the things that I kind of talk to people about, is like, right now, if you're in this 20% tax bracket, a lot of people are like, well, I got $1 million, should I tax it all out? Or should I cash it all out and do something else with it? Maybe put it into real estate or something like that. I'm very cautious, and I don't believe in telling people what they should or shouldn't do. I think you've got to come to your own conclusions. And I think any advisor that tells you you should leave your money in or you should cash it out is not to be trusted. I think you just need to understand and make your own educated decision as to what your risks are. And at the end of the day, nobody knows, right? Taxes could go up, taxes could stay the same. I can't visualize a world where taxes go down, but you know what? To say it's not possible would be delusional as well. Anything is possible. If there's one thing I know, it's that the government has really surprised me on their ability to manipulate and control the economy in a way that most people can't comprehend, right? So I won't even say that it's impossible for taxes to go down. Now, do I believe they're going to go down? No, I believe they're going to go up. So I look at this, and a lot of people would say, all right, when you're earlier than 59 and a half, okay, let me just do this. If you have to understand that there's a couple things going on. So if you're 59 and a half is the number, if you're younger than 59 and a half, you have to pay a 10% penalty to access your money. Okay? It's important to understand that. Now, you're always going to have to pay income tax, earned income tax. But remember, a lot of people are like, wow, if I take this $1 million, I'm going to have to pay income taxes and penalty, and I don't want to do that. Now, the one thing I will say is that, let's say you're earning $100,000 a year or $150,000 a year and you have this $1 million. You don't want to cash all $1 million out at once because it's going to bump you up into a higher bracket, and you don't want to do that. You want to make sure you talk with a CPA, talk with an accountant, talk to it. Ultimately, the best case is to talk to an enrolled agent who is a better planner than a CPA or a typical accountant. And so an enrolled agent can help you figure out a plan to distribute this $1 million. And yes, you're going to have to pay a penalty, right? And yes, you're going to have to pay taxes. The taxes are unavoidable, right? You just want to make sure you don't pay more in taxes in your life than you need to. And a lot of people freak out about this penalty because they say, wow, I'm going to have to pay $100,000 on this money to access it before I'm 59 and a half. My argument to you, and the reason I would do this, but once again, I'm not saying you should do this, is saying, well, if I believe taxes are going to go up, I want to control that money, because when the money's in the 401k, I don't control it. I can't invest in other opportunities that are probably the best investment opportunities in times of hardship, right? So yes, am I losing that 10% in the short run? I am. But if I think taxes are going to go up from 20 to 30%, I didn't really lose anything, because I'm going to lose that anyway. I'm just preemptively doing it to take control of this money so I can take advantage of other opportunities. And I would argue that the opportunity cost of keeping the money inside of your 401k right? Keeping the money inside of the 401k here, that opportunity cost is going to far outweigh the 10% penalty. Now, that's not the same for everybody, right? Because it's important to know that control of money, right, has a different value for every single person in this world. I could have control of $1 million, you could have control of $1 million, and the amount of return and what we do with that money is going to be completely different for me versus you, right? I would venture to guess that I will beat most people that are watching this video when it comes to getting returns on the $1 million based on my level of knowledge, expertise, my connections, my relationships, my access to opportunity, right? But you have to grow into that. And what happens is when you take massive responsibility for the results in your life, I'm a big believer you are where you are because of who you are with your money. And by taking control of your money, by taking control of your 401k, by looking for opportunities, and by growing yourself in that way, you're grabbing control of this money, you're taking it out of the system, you're eliminating the taxation risk because, listen, it's not beyond the realm of possibility that this 30% could be 50%, right? And now all of a sudden, that 50%, instead of having $1 million, that right now equals 800,000, right? That million could actually equal 500,000, right? So you could just lose literally $300,000 of your own money. The government literally has the legal rights and ability to tax your wealth away from you. And with, like I said, when we go back to this and we go, okay, when we look at this number and we look at the debt clock and we look at the unfunded liabilities and we look at everything that's going on here, I don't think it takes much convincing for most people to realize that the risk of having your money in a 401k is a significant risk, not just because of the market risk, but because of that taxation risk. So the key thing to understand here is that in a 401k, you don't get a tax deduction. You may technically get a deduction this year, but what you're really getting is a tax deferral, and the taxation risk that comes with that deferral is significant, and the opportunity cost keeping your money in a 401k is significant. And my focus with all the clients that we work with all the people that we work with here at Life 180, is to not focus on how to get you a deduction and to reduce your tax liability in 2023. Our focus is to say, hey, listen, you can't solve long-term problems with short-term thinking. By trying to get a deduction today, that's short-term thinking. What we need to think about is, how do I reduce my tax liability over my lifetime? And for that, you need to have a better plan, and you need to have a little bit more vision for the future on what you're trying to accomplish in your life. So typically when people get to the end of that rainbow and they go down that journey, they realize that a 401k is just not in alignment with their values and beliefs. So I'd encourage you, if this is something that you want to dive into and check it out, we've got full CFPs on the team. We've got, just set up a call. There's a link down below. Set up a free clarity call. I can connect you with one of our financial planning experts, with one of the coaches on the team. If you are interested in a 401k, make sure in your notes, if you have your 401k and you're interested in talking about it, or an IRA, or interested in rolling any of that money over, make sure that you mark it, or in the notes, write 401k in the meeting notes. That way I connect you with the right people on the team that can help you with that. And that's it. I mean, hopefully this gives you clarity a little bit more about that, because I think the 401k conversation and tax deductions versus deferrals and all that, it's not talked about enough. It's a bit confusing. I know it could be overwhelming, but hopefully this video gives you a little more clarity about it. If it did, I would ask that you like the video, share the video. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. I got videos like this coming out every single day. And that's it for now. Have a blessed, inspirational day. Till next time, we'll talk soon. See ya.